Everybody should know what their roles are going to be when the owner is no longer there.
The small business owners, the backbone of the economy. I believe they employ the most people in the economy, right? So for that, they should get that benefit.
I agree. When the spouse for whom the trust was designed dies, what's in that trust will then devolve into separate shares for each of the owners or the creator's children. Now those shares pass down to my children, implementing a plan to try to reduce the taxation on the sale. At that point, it's too late.
Hello, everyone, and welcome. My name is Paul Palumbo. I'm the host of the Palumbo Podcast, where we interview some of the most successful founders of businesses to learn about their journey to the top and their successful exits, as well as talk to professionals who specifically focus on founders and helping them with a strong exit. Today, we have with us Jason Marx. Jason is a partner at Mendelbaum and Barrett PC, where he serves as strategic advisor to high net worth and ultra high net worth individuals, families, executives, and business owners. His practice spans estate planning, estate and trust administration, elder law, taxation, and business succession, helping clients protect what they built and plan effectively for the future. So, Jason, thank you for your time today. I appreciate it.
My pleasure, Phil. Thanks for having me.
All right, good. So to start off, Jason, why don't you tell us a little bit about your specialty and what you do?
Sure. So I'll consider myself first a tax attorney first. I do have an advanced law degree, an LLM in taxation, which is a master's of laws, which I achieved at NYU after I finished my law degree at Seton Hall Law. But for the past 29 years, I've been focusing my tax and estate planning career mostly in the area of high net worth and ultra high net worth estate and asset protection planning.
Terrific. So Jason, so one of the key things and focuses that we had spoke about is my business, which is focused on founders who are looking to exit their business. And one of the things I'm really trying to hit home for a lot of these individuals is to help them understand the importance of planning and how that can save them money in taxes over time for both them post-exit and for the family longer term. What is your view as it relates to that?
Oh, absolutely, Phil. You know, one of the things that I try to hit home with my business owner clients is plan early and plan often. You know, it's more than just focusing on the tax side of things, where a business owner has a well-designed succession plan. They not only focus on tax optimization when the time comes that there may be a liquidity event, but they ensure that there's a proper succession of the business. It ensures the continued uninterrupted operation of their business, which leads to increasing or preserving the wealth and the value of the business for either the next generation or the successors, whoever takes over.
Yeah, which is really important because there's a statistic out there that 50% of businesses are almost forced to go to sale because of divorce or health reasons and obviously death, right? So the key thing that we try to really hit home for a lot of business owners is to really have great asset protection in place as well as a succession plan. And when it comes to succession planning, if you just had to guess, I'm not holding you to this, what percentages of business owners have you spoke to that actually have a very strong succession plan in place or any succession plan at all?
Those who are my clients, they have very strong succession plans. Those who are coming to me don't. So, you know, I'd say several have something in the works, but it hasn't been fully thought through and it hasn't been implemented. And the implementation starts with the basic foundational plans, you know, the powers of attorney, the living wills, making sure that the corporate governance documents are updated to ensure that there is a succession or at least, you know, succession and authority if the business owner is unable to continue to operate the business before the succession becomes effectuated. You know, beyond that, you know, the use of gifting arrangements, trusts, you know, buy-sell agreements, if you have, especially where you have businesses that are not intra-family or, you know, owned between family members, but owned by partners who are unrelated. Having the properly designed shareholders agreement or operating agreement, depending upon the structure of the business enterprise, is essential. And making sure that the mechanisms are in place in those documents to ensure that there is a proper buyout of the other or approval of continuation of ownership by inheriting heirs and beneficiaries.
Right. So when you're speaking to your clients and you notice that the business is dependent, very dependent on the owner of the business, what does that mean as it relates to succession planning? Do you make any changes in the succession plan? Do you advise anything to your client in regards to the business being so dependent on that owner that if something were to happen, disability, death, or whatever it may be, it can be problematic for the valuation of the business going forward?
First thing I always do is I do an audit of their corporate documents, their business documents, their legal documents, making sure that I understand, what happens if the owner suddenly becomes disabled, can't operate the business any longer, or decides, suddenly that he or she wants to retire, he doesn't want to do it anymore. At that point, we make sure that that the mechanisms, the documents are in place so that somebody can take over, whether it be a succession in officership or ownership, but there's somebody who can take over and continue to operate when the owner steps down.
Right. So just to simplify it for my audience. So the benefits of a succession plan is what? What are the top two main benefits?
Continuity of business. Continuity of business often equates to maintaining customers and continuity of ownership and transparency. Because if before the owner decides to step away or unexpectedly dies, if the continuing owners, employees, those who think they're going to succeed or hope to succeed, don't actually take over the control of the business, they should know in advance. Everybody should know what their roles are going to be when the owner is no longer there.
Right. So continuity of the business. But so if you have continuity of the business where you maintain your customers or clientele, that means you most likely you kept the valuation of the business, which can be helpful for the family.
That's exactly correct. That's exactly right.
So let's shift to the biggest question that a lot of founders have, right? So any founder that's looking to sell their business, the first question they're asking themselves, okay, if I sell the business for this amount of money, is that amount of money enough for me to maintain my lifestyle so I don't run out of money at some point in the future? That's definitely the first and most important point that you see a lot of founders, or a lot of, as far as their mindset overall. Then the second question is when they go to sell their business, what's the net amount going to be for them? And what can we do as professionals to advise them? So if they go to sell their business for 50 million, that they get as close as possible to the 50 million, reducing any taxation. Well, that's the first part. And then the second part they have to think about is what can they also do today from a legacy standpoint to mitigate any type of federal estate taxes down the road or state estate taxes for the family. So there are things business owners can do prior to selling that could help as it relates to the post net amount number and what it means to generational wealth and preserving that wealth for multiple generations. So Jason, let's tackle the first piece. So you and I spoke offline about this. So if you can first go through QSBS, what it is and what founders need to know about that.
Okay, sure. QSBS is an acronym that stands for Qualified Small Business Stocks. And it is governed by Section 1202 of the Internal Revenue Code. And essentially, where you have a qualified small business, where the founder owns shares of qualified small business stock, upon a liquidity event, there is the exclusion, assuming they meet all the requirements of Section 1202 of the code. They've held on to it for the requisite number of years. The valuation meets the requisite valuation requirements. They are founding shareholders. The owner, upon sale of the stock, this would be in an equity sale. The founder of the owner of the shares of stock could exclude anywhere between $10 to $15 million of federal gain.
So to put it in perspective, so if you have a business you're looking to sell for 20 million and you have a long-term capital gain of 15 million, if you qualify, that $15 million capital gain could be completely wiped out.
Right. It depends upon when the company was formed. Prior to, I believe it was June of last year when the One Big Beautiful Bill Act was enacted. Prior to that, the limitation was $10 million. After that date, depending upon when the company was formed and when it gets sold, it's anywhere between $10 and $15 million is the exclusion from gain.
So that's some serious savings.
It's a lot of savings, and where you have a qualified small business, there is the possibility also of being able to stack the ownership of shares between the founding owner and certain trusts that qualify as individual taxpayers. So for income tax purposes, the trust has to be its own separate taxpayer. We refer to those as non-grantor trusts.
Right.
There are many ways in which a trust can fail to meet the requirements of being a non-grantor trust. So it is really essential that proper legal counsel is obtained in order to go through the trust, design the trust so that whatever the situation is, it doesn't trigger a grantor trust status, which would cause the shareholder then to be treated as the taxpayer, and you lose the benefit of that trust being a separate shareholder for QSBS Section 1202 purposes.
So just to go back, right, those founders that are listening right now, going back to the qualifications, and you said it before. So the qualifications are the business has to be in business for a certain period of time.
Right.
Do you know what that number is?
If I recall correctly, I think it's 5 years.
And it has to be the original founder.
It has to be the original founder. Gifts of stock, certain gifts of stock can also allow the grantee, the donee of those shares, to also be treated as founders for Section 1202 purposes.
And is there a minimum revenue or profitability threshold?
No. But if you have a company that's got that kind of valuation, chances are you've got a pretty profitable company in the first place.
Absolutely. Any particular industry is qualified?
Yeah, what I would always recommend is having the founders hire. I believe you can go through large accounting firms who may be able to provide this, an analysis and determination that the shares do meet qualified QSBS status.
Right. Well, that's
having that will provide the support behind taking the position when the sale eventually occurs that the gain is excluded up to the threshold limits.
Why do you think the government allows for this incredible benefit?
That's a good question. I don't know that I ever really gave it much thought. I think, if I were to take an educated guess here, I think it's to encourage business, to encourage entrepreneurship.
I agree with you. I agree. That's they employ these small business owners, the backbone of the economy. They employ, I believe they employ the most people in the economy.
That's correct.
Right. So for that, they should get that benefit. So it's
I agree.
One of the reasons why
one of the things that I also want to point out, it is limited to C corps. S corp shares do not qualify. Ownerships in LLCs do not qualify. LLCs taxed as C corps do not qualify. It is C corp.
Wow, that's interesting because that is a big difference, right? Because
it is a huge difference because most small businesses are not treated as, do not keep the C corp status. Most either elect S corp status or formed as LLCs.
Right. So if I'm someone listening to this, like right now, my business currently is an S corp, not a C corp, right? So can you go into a little bit of the nuances of, if I'm an S corp, can I convert to a C corp to take advantage of this pre-sale?
No, it has to be a C corp from the beginning.
Wow, interesting. In C corp, the taxation on that is higher than S corp, right? That's typically why business owners.
C corps are subject to taxation at the corporate level,
right?
And then distributions to the shareholders are taxed as dividends.
So it's double taxation.
The double taxation that you hear a lot about.
Right.
Whereas S corporations are not taxed at the corporate level; they're pass-through entities, much like an LLC or a partnership, and so the income is passed through to the shareholders and taxed at the shareholder level.
Right. So if you have $1 million in profits, that's taxed at about 21% on the C corp level, and then that $1 million is passed through to the owner's tax return. Then you taxed at whatever bracket that may be, and whatever bracket that you're actually in.
And it would only be based on distributions if there's a distribution made to the shareholders. So Whereas S corporations and partnerships the owners are taxed on distributable income.
Right.
C corp shareholders are taxed only on distributed income.
Right. Only if it's distributed. I can leave it in the business and just leave
You
it
can
in the
leave it in the
business.
business as earnings and profits, and it'll stay there and be reinvested into the capital, the enterprise, and used for business purposes.
And so, like you said before, so if I'm looking to sell my business in 10 years, I say, wow, that's a huge benefit with capital gains. I can't convert today from an S to a C because the trail of that would disqualify me for QSBS.
Right.
Right. Okay, so QSBS is one thing to think about if you're a C corp. What about installment sales? Any benefits in that for people looking to exit?
Yeah, I mean, installment sales are great in terms of deferring taxation. Doesn't eliminate the tax; it'll still be paid, but it allows the owner or the seller of the business to defer recognition of income into future years when payments are received.
Who sets it up? Someone like you?
I would set it up depending upon the nature of the transaction. I have partners here also in my corporate M&A department who I work with. So I do a lot of corporate work as well. So I do a lot of transactions, setting up membership interest purchase agreements and stock and shareholder agreements for sales. But there may be some transactions that are beyond my limits as a corporate attorney,
right?
Where I have partners here who I work with.
Got it. ESOPs, which we're not going to really get into, but it's something for people who are listening to maybe look into as well. That's something 2 to 3 years prior to sale is a situation where you could sell your business to your employees, and it could become a non-taxable event for you. So it is another opportunity in the ESOP world. There's a lot of things to think about in regards to that. So there are things that founders can do pre-sale that could help them post-sale. What I talk about a lot, and that's more of my business in my wheelhouse, is more the tax loss harvesting strategies with various money management firms that if you sell on January 1st and you have a capital gain, you can invest the money in a way to offset anywhere from 50 to 90% of that capital gain. So from an investment standpoint, there are strategies where you could really mitigate a lot in taxes, which can really help save millions of dollars for the founder. So I want to transition now more to the estate planning side of things. So, the thing that I've tried to constantly talk to owners and founders about is the idea of pre-tax planning 2 to 3 years out. When you do that, there are things you could do from an estate planning standpoint that could really help build generational wealth over multiple years, saving millions of dollars in taxes. So let's talk first about the SLAT. So just tell us about what a SLAT is first, and then we'll get into how to use it in helping build multi-generational wealth.
Sure. So when in estate planning, there are a lot of acronyms. I refer to as the alphabet soup of estate plans. So a SLAT is an acronym, stands for the Spousal Lifetime Access Trust. And it is essentially a trust where one spouse creates a trust for the benefit of the other spouse. It's an irrevocable trust for the benefit of the other spouse, and it may also include their descendants, their children, grandchildren, more remote descendants as beneficiaries. So in a situation like what we've been talking about with business owners, a owner of a business can transfer equity interest, whether it be an LLC, corporation, S corp, whatever it is, shares of stock, into the SLAT. The trust will become the owner of the SLAT, the trust will become the owner of the shares for estate planning purposes. The trust is an irrevocable trust, so at that point, the transfer is a gift for the benefit of spouse and descendants. Excuse me, it would be a completed gift, so the gift would have to be reported on a gift tax return. And I'll explain what the gift tax consequences will be in just a second. When the spouse for whom the trust was designed dies, what's in that trust will then devolve into separate shares for each of the owners or the creator's children. Now, that devolution of assets could be outright to the children. More likely than not, it'll be into continuing trusts for the benefit of children and more remote descendants. And the nice thing about New Jersey is that we can engage in multi-generational planning called dynasty trusts.
Right.
so that the wealth that accumulates in that SLAT continues on for multiple generations. And once it's in the trust, it'll be outside of the estate of the surviving spouse and children and further generational beneficiaries. The risk associated with this SLAT, excuse me, the risk associated with the SLAT is what happens if the spouse for whom the trust was created dies first. Remember, if I'll use myself as an example, if I'm an owner of a business and I create a SLAT for the benefit of my wife and my children, and I put shares of stock into that SLAT, okay, distributions of income or can be made to my wife, and I can benefit indirectly. She can always pass it back to me if I needed it. Okay, my wife dies, now those shares pass down to my children. I can't get it back from them unless they agree to give anything back to me, number one. And number two, that becomes a taxable gift from them back to me.
So I want to just stop you right there if you don't mind, right? So all really great points. So for example, if you take someone who has a net worth of, let's say, 50 million, right? And they fund the SLAT, let's say they fund the SLAT with prior to sale, they fund the SLAT with $15 million worth of shares, but you're going to really fund it with 20 million because you can get a discount because it's illiquid. So
right.
The IRS
you'll value the shares. You'll hire an appraiser to value the shares and do a discount analysis for lack of marketability, lack of control purposes, so that you're actually giving away into the trust more value than what it's being valued at for gift tax purposes.
Exactly. So that 20 million is going in as 15. Now automatically you have 5 million that's out of your state that is not taxed federally. So now you got this money in the SLAT like we just talked about, right? And then the owner goes to sell the business and the cash then goes into the SLAT, and the cash now is, let's call it 20 million. And let's say it's for the spouse. So the spouse then can take the cash flow from it, put it in the spouse's bank account. So let's say, it's 20 million at 5%, right? Let's call it $1 million. That $1 million goes into the bank account of the spouse. Okay. Now the husband who owned the business can utilize that money indirectly for their lifestyle expenses.
Right. It can go into an account for the spouse. It can go into a joint account.
Right.
Either way.
Correct. So now fast forward, let's say the couple 60 years old, they die at 95. Let's say that 20 million is now worth 60 million. When they die, that entire $60 million is now outside their state. So there's no federal estate taxes, which would be 50%. So just by executing, 40% federally. It could be 40%, but then state can be another 10.
So in New Jersey, there's no estate tax.
But in New York?
In New York, there is an estate tax upwards of about 16%.
Yeah.
Now, the New York exemption, I mean, that's a whole nother...
all the wax, yeah.
New York's estate tax laws are pretty draconian in the way they have this cliff structure.
Right.
Essentially, the exemption, federal exemption is $15 million. New Jersey doesn't have an estate tax. We have an inheritance tax. So the difference between an estate tax and an inheritance tax is an estate tax is a tax that's based on the value of the assets that you have or are entitled to when you die. The inheritance tax is a tax that's based on the value of the assets that you leave to someone else. The rate of tax depends upon the relationship of the recipient to the decedent. So spouses, children, lineal descendants in New Jersey, they're all considered Class A beneficiaries. The inheritance tax rate is 0%. So for the lion's share of of clients who are planning for spouse and children, there's no New Jersey death tax. New York has an estate tax. The exemption for New York is about $7.3 million.
Right.
So anything under $7.3 million in the decedent's estate is excluded from the New York estate tax.
Right.
There's a 5% increase. Anything 5% above the New York exemption is subject to tax on that additional amount. But anything over that 5% amount, so if the estate exceeds more than 5% of the exemption, which is I think now about $7.8 million, New York has a cliff on the estate tax, which if the estate falls off that cliff, the estate is taxed at $1.
Right.
So there's a dichotomy. There's a difference between planning for New York residents from a federal and state standpoint.
Exactly. So going back to my example before, that $20 million now is worth $60 million, and person dies, you just saved the family $20 to $30 million in potential federal estate taxes.
Well, remember that what you've done when you've contributed the $15 million of value of stock to the trust, you're allocating your lifetime exemption from the federal estate tax to that trust. So now in using me as in the example I did before, I contribute $15 million worth of stock. It's truly worth $20 million. I contribute $15 million worth of stock to a SLAT. I'm using my lifetime exemption from the federal estate tax against that gift. So I no longer have it when I die. But now I've frozen the value of that asset at that level, $15 million. All that future accumulation from $15 million, or in this case, $20 million, up to $60 million, using your example, all of that future accumulation takes place outside of my estate and is estate tax free.
Correct.
And as long as I died with, outside of 3 years from the date of transfer, if I'm a New York resident, New York doesn't claw that back. Okay. New York, New Jersey, we don't have gift taxes. So the only state left that does have a gift tax is Connecticut.
Right. Yeah. So that's the reason why we do this. That's a benefit. But what I was going to get at next, so now that the audience understands how that works, then the next part is for them to understand, again, you have a husband, let's say during that period, the wife dies. So the wife dies, the SLAT then goes to the beneficiaries in the form of a trust. Now, if I'm the husband and I'm saying, well, I'm dependent on that $1 million of income, but now the wife dies, money goes to the beneficiaries. Is there a way to set something up in the beginning with the trust where the husband can still receive income from the trust, even though the children are beneficiaries?
Yeah. So what the strategy in this case is, and the back door of a predeceasing spouse is, as part of the plan, wife would create a trust for the benefit of husband that would sit there on the side until wife dies, if she dies first. Through her will, based on the SLAT, the SLAT would give the spouse what's called a power of appointment, where she can direct the assets outside of the default allocation down to the children. Okay? So that power of appointment would be exercised by way of the predeceased spouse's will, called the testamentary power of appointment. Okay? And by that power of appointment, she would direct the assets in the SLAT that was created for her to the SLAT that she creates for her husband, for her spouse. So now it goes from SLAT 1 to SLAT 2. Husband or creator of the initial SLAT is now the beneficiary, along with the kids and remote descendants of that SLAT number 2, so that if the spouse for whom the original SLAT was created dies first, now we don't have to worry about that. We don't have to worry about the assets in that trust no longer being available to the husband or the first SLAT creator as a beneficiary, and that spouse could then reap the benefits of the income and principal as need be, based on the trustee's discretionary distributions.
I think a lot of attorneys don't know that. And you can do that.
It's a backdoor to the SLAT.
Oh, listen, I love it. I think it creates a lot of calm with a lot of clients.
The alternative to that also is you can create, where you don't have to worry about who dies first, is certain jurisdictions, Alaska, Nevada, South Dakota, allow for the creation of self-settled trusts where, for example, I created trust for the benefit of myself as well as my spouse and my children. By creating a trust for including myself as a beneficiary, it's called self-settled. Okay, certain jurisdictions allow for the creation of self-settled trust and allow those trusts to exclude the value of the assets from the estate of the settler of the trust. Important that you follow. It needs to be designed very carefully, but you can create a trust. I gravitate to Alaska in these situations, right. But if I'm a beneficiary of that trust, then as a beneficiary, the trustee can make discretionary distributions to me. And so if my wife dies before I do, no harm, no foul.
Right.
There are additional costs associated with doing things like that, but
it's pretty comforting though to know that there's a way that the surviving spouse could still receive income from the SLAT, which is terrific.
Yeah.
So the idea and the main message we're trying to get across to a lot of people is that the bottom line is pre-exiting your business. There are things you can do to set your family up for multi-generational wealth. And yes, there's some loss of control, but there isn't some loss of control, right? So, and obviously you got to tread lightly on that, and through proper documentation, legally structure in a way where you'd be really comfortable with the structure overall. But the benefit, again, like we talked about before, it's the tax savings when you die.
That's right.
The last part is, well, where should I hold my trust? Should I hold it in New York? So let's say I have New York clients. Should I hold it in New Jersey? Should I hold it in Nevada? Should I hold it in South Dakota or Alaska? And one of the key, like for example, in New York, there's no what's called rule in perpetuity, right? So in New York, the trusts last 120 years. So basically it means that after 120 years, the trust basically have to collapse.
New York does have a rule against perpetuities. It's common rule against perpetuities.
Yep, I said it wrong. Correct. Yep.
The rule against perpetuities is a common law doctrine that basically says that a vested interest in a trust must at some point terminate, has to end. And whatever's in that trust then comes out. Okay. So in New York, you really can't do the kind of multi-generational planning that you can do in other jurisdictions. New Jersey eliminated the rule against perpetuities in 1998. So New Jersey, we can create dynasty trusts for our high net worth clients because the trusts here don't ever have to end. So for a lot of New York clients, I'll go to a jurisdiction like Alaska or Nevada, where you'll have where you're able to engage in dynastic planning for New York clients.
So can New York clients use a New Jersey trust?
They could. You can govern it by New Jersey law.
But the preference is really Nevada or South Dakota or even Alaska.
There are robust asset protection laws when it comes to Alaska and Nevada trusts. More so than what you have in New Jersey, which is why self-settled trusts that exclude the assets from an individual's taxable estate can be set up in a jurisdiction like Alaska, but not in New Jersey. Mm-hmm. Even though you can have multi-generational dynastic trusts, you can't do that kind of planning here in New Jersey because creditors can attach to it, which causes the asset to be included in the estate. Conversely, jurisdiction like Alaska, creditors cannot attach to it.
Right. Which is really important. All right. To summarize our conversation, the key message that we're trying to get across is, number one, there are things that business owners can do pre-exit, post-exit that could save them millions of dollars in taxes, so they have more money that they can use to maintain their lifestyle. That's number one. Number two, if the goal is multi-generational planning, there are strategies you can implement today to preserve your wealth through these SLATs that we talked about. So upon the second to die, husband and wife, assuming they live to 95 years and older, upon the second to die, you're going to mitigate millions of dollars in federal estate taxes and potentially New York state estate taxes, or whatever other states where they have estate taxes. And then number three, the selection of the trust is really important, especially for that multi-generational wealth opportunities. So that's really the key summary of what we're trying to get at with our messaging today. Anything else, Jason, that you'd like to add? The spotlight's on you to conclude the conversation.
No, as I said before, plan early and plan often. A lot of times clients will come to me with the expectation that there's going to be a sale, and they want to optimize the tax situation that they're going to be faced with. And they've already got a letter of intent from a buyer. They're already starting the negotiation process. They may be in due diligence, whatever, and they want to start implementing a plan to try to reduce the taxation on the sale. At that point, it's too late. Okay. Planning for the purposes now, tax avoidance is legal, whereas tax evasion is not. Tax avoidance is legal, but where a plan is implemented for where there's no legitimate business purpose other than to reduce taxes, the IRS is going to blow through that. Okay. And they're not going to respect the structure of the plan. Okay. Which is why I say, when you know or believe that you want to start looking for an exit, that's when you start planning, or before then. Have everything in place. You can always amend, you can always change, you can always update, but it's better to begin planning when you can and you have the capacity to do that. Make the plan, especially when it comes to business succession plans, make the plan transparent to your employees, to your other business owners, okay, to your family. Who's going to succeed? Who's going to take over the business? Is it going to be one of the children? Is it going to be all of the children? That's an important component, okay?
Yeah.
And make sure you plan for your liquidity.
Yep, I totally agree with you. That's why I always say to a lot of business owners and founders that, I'll always operate at best in class. Best in class means that you're operating at the highest level where you can get the maximum value of business from a multiple EBITDA level. But not only just that, but also best in class from the standpoint that for your family, creating that multi-generational wealth, meaning that you did your planning on the various ways that we just shared with you just now, and also structuring tax saving situations as well, pre-tax, post-tax, and finally a strong succession plan in place as well. That's operating at best in class. That's checking all the boxes, operating on all cylinders. And I got to tell you, Jason, if we took a scan of all business owners, which are 33 million in this country, I would bet that 5 to 10% are really that buttoned up. That's just my personal view. And knowing that there's risk out there.
I don't think you're too far off on that.
Yeah, I would. I mean, my personal view, right? I agree. But that's why, these messages and these podcasts and the content that we put out there, if we help one or two founders who not even our clients just speak to their advisors to take care of themselves and get to business class, then to me, it's mission accomplished. So Jason, thanks so much for your time today. Appreciate it. Great conversation. Look forward to continuing our relationship.
So do I. Thank you so much for having me today.
All right. Thank you.